What if a single government ban could shake every major stock exchange across the planet? What if Trump's new trade war with China sparked a global market crash, and this time, it's not just about tariffs, but total economic dominance? Beijing has just banned United States shipping firms, and in response, Washington fired back with a chilling warning. If they want to slow down the global economy, they'll be hurt the most. But who really gets hurt first, China, America, or the rest of us? Let's find out. Before we dive in, wherever you're watching from, if you want daily updates on global tech, AI, and market power shifts, make sure you subscribe and stay tuned. You're watching Scop, your lens into the new world economy, where politics, technology, and money collide. The shock came early this morning when China officially banned certain United States shipping companies operating in the Asia-Pacific corridor. Almost instantly, global markets reacted. Japan's Nikkei 225 fell over 2.5%, Europe's Stoxx 600 dropped nearly 0.5%, and S&P 500 futures were down nearly 1% before Wall Street even opened. When the market bell rang in New York, the sell-off was immediate, a wave of fear sweeping across traders who saw the move as an escalation in the already tense trade war between Washington and Beijing. Treasury Secretary Scott told the Financial Times that if China continued down this path, they'll be hurt the most. They're in a depression trying to export their way out. So what exactly did Beijing do? China announced new sanctions banning its companies from doing business with the United States subsidiaries of Hanwha Ocean, a major South Korean shipbuilder. At the same time, it extended export restrictions on rare earth materials minerals that the United States depends on for defense and high-tech manufacturing. The message was clear. China is tightening its grip on critical global supply chains, sending shockwaves through shipping, manufacturing, and commodity markets. But what's even more interesting is why China is doing this now. Beijing's internal data shows its export sector recovering strongly, up 8.3% in September, with GDP expected to grow 4.8% this year, far outpacing the United States at just 1.4%. So if China's economy is doing very well, why pick a fight? Analysts believe this is a strategic move to show the world that Beijing still holds the cards when it comes to global trade leverage. In Washington, the response was swift and sharp. President Donald Trump and Treasury Secretary Bessent have made it clear if China continues restricting exports, the United States will impose even tougher tariffs, possibly 100% on Chinese goods. Bessent's comments to the Financial Times weren't just a warning, they were a signal to global investors that America is ready to weaponize its economic strength. Maybe there's some Leninist model where hurting your customers is a good idea, Bessent said, but if China slows down the global economy, they'll be the ones to pay the price. Still, Wall Street doesn't seem convinced. Today's sell-off shows traders are bracing for a long, drawn-out economic battle, one that could trigger another round of global volatility. The panic wasn't limited to stocks. Commodities, currencies, and crypto all moved violently in response. Oil slipped below $78 per barrel. The U.S. dollar index spiked to a 2-month high, and gold briefly surged above $2,600 as investors rushed for safety. Meanwhile, consumer confidence is sliding fast. Pantheon Macroeconomics warned that U.S. core spending growth is near zero, a massive drop from the 6% rate earlier this year. Even Goldman Sachs released a gloomy note titled "Jobless Growth," predicting that future economic expansion will rely mostly on AI-driven productivity, not job creation. Put simply, the global economy may keep growing on paper, but the real people driving it are slowing down. Despite the panic, long-term analysts remain surprisingly optimistic. They point out that half of the current S&P 500 bull market is being driven by just 7 mega-cap tech companies: Amazon, Apple, Alphabet, Meta, Microsoft, Broadcom, and Nvidia. These giants are not only resilient, but fueling global productivity through AI, chips, and cloud infrastructure, exactly the areas least affected by trade restrictions. Even with today's crash, experts expect AI and semiconductor stocks to recover first, as investors shift focus back to innovation rather than tariffs. As rate cuts continue and inflation cools, the foundation for another bull cycle might already be forming beneath the chaos. What's unfolding right now isn't just about trade, it's about who controls the global economy's future. Beijing is asserting its dominance in manufacturing and minerals. Washington is leveraging finance, tariffs, and technology alliances. Each side is trying to rewrite the rules of globalization, not through weapons, but through supply chains and sanctions. This moment could define the next decade. Will the world split into two economic blocs, one led by the U.S. and one by China? Or will both sides find common ground before markets spiral into deeper chaos? So, is this the start of a new global market crash, or just another power play between two superpowers? If this conflict escalates, it could reshape everything from oil to semiconductors to AI innovation itself. Tell me what you think. Will the market recover by November, or are we heading into a deeper recession? Comment below, and if you want more in-depth analysis on global economics, AI, and market power shifts, make sure you subscribe and stay updated. This is Scop AI. See you in the next video.